Hey guys, in this video I want to share with you Vanguard's most recent monthly economic market update. And there's so much noise in the world these days, and there's so much negativity in the news, on YouTube, on Facebook, that it's really hard to understand where we are in the economy. So I appreciate that Vanguard looks at this economic model to forecast how they think the market's going to work as we progress through the year. And so this is as of March, the early part of March that I'm recording this. So we're going to look at the economic forecast for the remainder of the year, and then we're going to look at a couple of other items that I think you're going to find really valuable. So let's dive in. Okay, so this is Vanguard's outlook for financial markets. This is their 10-year annualized nominal returns and volatility forecasts. So the couple things I want to bring to your attention here. First of all, U.S. equities are projecting to be between 3.7 to 5.7%. Value represents 4.3 to 6.3% of that, and growth stocks represent 0.9 to 2.9%. The other thing you'll notice is that U.S. large cap represents 3.7 to 5.7% returns over the next 10 years, whereas small cap represents 4.3 to 6.3%. So a couple of things I want to bring to your attention as we're exploring the U.S. market. First of all, you'll notice the expectations for value are greater than growth. That's what the academic research would tell us to be true in the long haul, not necessarily in the short term, but in the long haul. So one of the reasons that we recommend that we tilt portfolios towards some of these drivers of higher expected returns, things like value being one of those drivers of higher expected returns. Another one is you'll notice that small cap is expected to outperform large cap. And so again, we like to help our clients tilt their portfolios towards higher expected returns. So this 4.3 to 6.3%. Now, the other thing I wanted to talk about are global equities. You'll notice that their developed markets, excluding the U.S., are expected to be 6.9 to 8.9%, and emerging markets 6.1 to 8.1%. One of the things you've heard me say for years now over the podcast is that we believe in having a broadly diversified portfolio across asset classes, across sectors, and across the entire globe. It's been said that diversification is the only free lunch in investing. And yet I still see people taking concentrated bets in individual companies. And I've got a couple of other things I want to show you. So let me grab those slides. The purpose of this slide is to show the benefits of diversification. Diversification helps take the guesswork out of investing. So you can see the S&P 500 index is where a lot of people have a lot of their money allocated. In some years, that has not been a great performer. In other years, the S&P 500 index has been one of the better performers. There have been years when the Russell 2000 index is the better performer. And then, of course, years when Dow Jones U.S. Select Real Estate Index is going to be the better, and then years when small cap is going to be better. So the problem is we don't know which asset class is going to be the best performer year after year. So instead of trying to guess, what we do is we create diversification across all these different asset classes and sectors, and then we rebalance the portfolio to maintain that asset allocation over time. And rebalancing is really more of a risk mitigation tool than an asset optimization tool. The next thing I wanted to take a look at here with you are the returns of developed markets. So again, it's really easy to assume that we just want to be in the US, but if you look at this 20-year stretch from 2003 through 2022, just looking at developed markets, you'll notice 2014 was the only year that the US was the best performer. So again, this is one of the reasons why we want to be globally diversified, broadly diversified across the entire globe, because we don't know which country is going to be the best performer year after year, but we do want to have exposure to some of these different countries. The next slide looks at the equity returns of emerging markets. So you can see Thailand, Colombia, Egypt, China, Peru, Brazil, Thailand, Indonesia, Turkey, Taiwan. We don't know which one of the emerging markets are going to be the highest drivers of returns from year over year. But again, we want some exposure to these returns so that when they do perform, we have access to some of that within the portfolio. One of the things I think is really important to understand, because again, I still see people doing this single security, buying individual stocks, when today we have access to low-cost index funds using ETFs to give you that broad diversification, to give you these portfolio tilts towards value and small cap and profitability. You don't have to go out and try to buy the individual stocks to give you the performance that you need. And the purpose of this chart is just really to point out the fact that diversification is your friend. Diversification is going to help you smooth out some of the bumps along your investment journey. But it's not just about investing, because what we need to understand from a financial planning standpoint is what rate of return do you need to earn in order to make your money last for the rest of your life. So let me show you how we do that. The key to a successful investment strategy is starting out with a successful financial plan, with a good financial plan. You want to run the numbers beforehand, and then you want to update the plan as you go to make sure that everything's working as expected. So in this very simple plan, we have John and Nancy, and you'll notice they're retired. His life expectancy based on the Social Security mortality tables is age 82. Hers is age 85. They've got good assets, so $2.5 million of assets. Now, not all of that is liquid, so you'll notice some of it, $1.4 million, is liquid, $850,000 is in real estate and some other property that they have. But over here on the future view, we can start to model their cash flow. So you can see they're going to have a shortfall in retirement. They're going to have to dip into their accounts to make up for the difference. But if we assume that their money's only growing at 3% per year, and we run the numbers down, you'll notice his life expectancy is the blue line, 82. Hers is the pink line, age 85. So if they only get 3% per year, we get them down to they have $663,000 remaining at life expectancy. But what would it look like if we could get 4% per year? And so, we can assume a higher rate of return and see 4%. Or what if we say that they're only going to get 3% per year, but they think that they've taken really good care of themselves, so they're going to live a lot longer. They're both going to live to age, say, 95. We can make our hereditary adjustment, come back over to the future view in the retirement budget calculator, run the numbers down, and you see, now if at age 90, they run out of money in retirement. So that 3% return is not going to get them where they need to be. So now we can say, okay, what if we had a 4% return? How does that help? And that gets them both down to age 94. So in their case, if we want to make sure that they're going to be able to make it all the way to, say, age life expectancy, we know that we need to be shooting for about a 5% return. So now that we know what rate of return we need, now we can start to construct a portfolio that's going to help them achieve that with the least amount of volatility, but with as much growth as necessary. Now, there's a couple other things you need to be thinking about, because when you retire, sequence of returns becomes one of the biggest risks you face. And there was an article that I just mentioned in my last YouTube video that I'll link to below if you're interested in watching it. But it talked about some of the economic indicators that could point to a short-term problem for securities. One of the things I forgot to mention in that article, let me pull it up real quick so we can look at it together. Okay, so in this article that was published on Yahoo Finance, and I'll include a link to this below too, where it talks about some of the potential problems for the stock market and the economy in the next few months. One of the things I liked about this article at the end was it talks about the benefits of being a long-term investor. And it says history is actually a long-term investor's best friend. It says that only 3 recessions of the 12 that have occurred since the end of World War II made it to the 12-month mark, and none of the remaining 3 lasted longer than 18 months. In other words, downturns in the U.S. economy are fleeting. And then a couple other things it says. The 27 bear markets over the past 94 years have stuck around for an average of only 286 calendar days, about 9.5 months. And this demonstrates the power of time and perspective for investors. So when we know this information, when we know that broad diversification is our friend, when we know that we can use low-cost ETFs and index funds to create that broad diversification, when we know that we can use the science of investing to tilt portfolios towards the drivers of higher expected returns, how do we also construct a portfolio as we're heading into retirement that puts time on our side? And if we go back over to the retirement budget calculator, remember, this helps us understand the rate of return that we're going to need your money growing at every year to have a successful plan. But the other thing that we can do is we can see how do we diversify our money across time segments so that in the event that we do experience a rough patch in the economy or in the stock market, that we can weather that storm. And the idea behind buckets is that money you need in the short term, you want to be relatively low risk. Money you don't need for a long period of time, you can invest more aggressively. So in this model, based on this plan that we built, you can see that they're going to need $145,000 for the first 3 years of retirement. This $1 million they're not going to need for 10 years. So that's the money, because we have time, we can invest that money more aggressively. And if we do run into short-term hurdles, we know that we've got a very conservative cash bucket, income bucket, and then we have a conservative bucket for years 4 through 6. Because, again, going back to this article, we know that of the 27 bear markets over the last 94 years that have stuck around, only an average of 286 calendar days, or 9.5 months. So we're just trying to create a structure that puts time on your side, so that when bad things do happen, and bad things will happen, that's just normal, you've got a plan that's going to be resilient, and you're going to be able to sleep well at night and have a great deal of confidence. Again, I'll include the links to these in the description below, but I hope you found this helpful. Thanks so much.